Welcome to the latest Motley Fool Scoreboard. I'm Anand Chokkavelu, and we've got longtime fools Jason Hall and Toby Bordelon giving a 1 to 10 rating to a favorite of dividend seekers. It's the largest U.S. telecom, Verizon, ticker symbol VZ. Talk about the business first, including factors like industry and competition. A 10 is invincible, a 1 is hopeless. Both of you have 7s here, Toby.
Yeah, Verizon is indeed a large telecom, but it does have serious competition from AT&T and T-Mobile. They offer wireless services, as we all know, of course, along with broadband, high-speed internet, enterprise networking, some security solutions, that sort of stuff. I did go with a 7 here, in part because it is a very competitive industry, but it's also fairly stable. There are high CapEx requirements, but that means it's hard for anyone else to jump in. And the industry, in some ways, seems like it's reached an equilibrium, competitive, but no one can get a clear, sustainable edge over anyone else. And Verizon does have relatively stable cash flows that make it a consistent, somewhat boring dividend player. What you see is what you get here.
Yeah, I largely agree here. Tons of economic moats, but as Toby says, it's also expensive to maintain. Not to mention that whenever the next generation of wireless standard comes out, and yeah, we're 5G, that's going to become 6G. It's table stakes to upgrade the network, and then there's also just minimal room to grow from where the business is today.
Yeah, even as we've had all this consolidation in the telecom space, it's still so highly competitive. And Verizon used to have, you could say, hey, they have the best network, and that was something. Not so much anymore. They're pretty commoditized, so far as I can see. Let's talk about management. A 10 is Warren Buffett. A 1 is Homer Simpson. Jason's at a 5. Toby, you're at a 7.
Yeah, honestly, nothing special here, but part of my reason for a 7 is I'm not sure you have to be special to succeed here. If you're an investor, what you want from management, I think, is for them just not to screw it up. And fortunately, they really haven't, at least not since that ill-fated AOL and Yahoo acquisitions last decade, which the management at the time bizarrely decided to smash together to that oath business. Some of us may remember, but I'm sure shareholders prefer to forget. If you have Verizon management, the goal here is just to keep the cash flow machine running. And performance has been fine, I think, under CEO Hans Vestberg. One of his first acts when he took over in 2018, incidentally, was just to take that massive write-off from all that oat stuff and get that off the table, move on from that disaster. He's focused on expanding where it makes sense, but nothing too dramatic, just kind of incrementally so. I think that's what you want here. I give him a 7 since they seem dedicated to not screwing up what they have, and I think that is an underrated skill.
Yeah, I think that's largely right, Toby. But the reason I give a 5, and again, thinking about this, we're not grading them. I think on a scale of 1 to 10, 5, that's your average. So I'm going to say they're average. And you can't reward a management team that's been in place for more than 6 years that hasn't delivered any value for shareholders. Let's start with the stock price. It's down 16% since Vestberg took over as CEO. Its competitor AT&T stock is up 14%. Even with the dividends, total returns are 21%. That's 25% of the returns that AT&T investors got. Massive underperformance of the market. You shouldn't really be expecting this to beat the market. And let's give them the benefit of the doubt too. Let's just look at the financial results. Well, revenue's basically flat. Operating cash flow is up 10%. Hey, there's a positive. Free cash flow is up 38%. That's better. But we're still talking about very low single-digit increases. And hey, what about share buybacks? This has to be a buyback company, right? That's juicing returns for a slow growth business. No, the share count's up 2% under current management. So you put all that together and they've been fine, but the business has not delivered for shareholders.
I think that's fair, Jason. I was kind of grading them on a curve relative to prior management, but I see the average argument for sure.
Yeah, I mean, you can't give them extra credit for not crashing the car.
It's fair.
Fair. I mean, 1/4 of AT&T's, no one's running out into the streets about their AT&T returns in recent years and have seriously underperformed them. Fair enough. All right. Well, it averages out to a 6, so the 5 and the 7, we'll take care of it. Wisdom of the crowds, 2-person crowd. Let's talk about financials. A 10 is a fortress. A 1 is yikes. Both of you are at 6s, Toby. You guys did the averaging already.
Yeah, it's fine for what it is. Debt is massive, but it's a hugely capital-intensive industry. Lots of capital tied up in equipment, spectrum licenses, and there's really no way around that. So debt is just a fact of life here. It's sustainable for now. They can support it while continuing to incrementally expand and pay that dividend. Would I like to see less debt? Sure. Does it really matter? In this industry, again, it's just a fact of life. As long as they can keep the payments reasonable and keep up the dividend, it's fine. I think you'd be aware of it, but you don't get too worried until you see some cash flow deterioration.
Yeah, I think Toby's basically right. Again, getting back to that AT&T comp, it's not a perfect comp, but it's useful. It's more leveraged than AT&T. The good thing, though, is the trends have been more favorable. The leverage ratios have been improving. That has come down some. And I do think the dividend, if we're talking about financials here, we have to talk about that. The dividend does seem to be generally safe. Payout ratios in the mid 60s. On a cash flow basis, it's in the 50s. It's pretty good. But again, that share count keeps going up. And the company's going to have to refinance a good bit of its debt at higher rates in coming years. That means that margin of safety for cash flows is going to get thinner, barring more asset sales to help pay down debt. And then, of course, the risk is at what cost of future cash flows if you're selling off assets to pay down debt.
Jason, let's move on to valuation. How well will Verizon stock do over the next 5 years, including that meaty dividend? And how safe is it? 10 is a sure thing. 1's a lottery ticket.
Yeah, I'm on the lower end of the 5 to 10% range here. I think the safety score for me is about a 7, which is relatively safe again for a long-term hold. I think they probably don't have to cut the payout. But if the debt markets are unfavorable, the board may not have control over that decision. We've seen like Kinder Morgan ran into that problem with debt markets where they had to cut their payout about a decade ago. So I'm a little less trusting of that 6.2% yield as being the floor for future returns.
Yeah, I'm in that 5 to 10% range too. I think probably on the higher end of that versus Jason. A big part of that return is going to be those dividends. That's why you buy this company, right? If you don't want dividends, I don't know why you're here. On safety, 8. I think they're not going anywhere. They generate cash. They can pay their bills. No one's coming to eat their lunch. It seems fairly safe to me.
Yeah, I think between the two of us, the answer is probably going to be somewhere in the middle there.
Yeah.
Dividend's definitely why I look at it every so often like, well, maybe, no. Jason, let's move on to everyone's favorite topic. Is there a company in Verizon space you like more?
And honestly, no, I can't name a single stock that's in the wireless or telecom sector that I find interesting or compelling. So as Toby said, what are you even here for? It's the dividend and the high yield that's hopefully safe. Just go buy Realty Income. It's much safer. The yield is 5.5%. It's lower, but it's grown its dividend at about twice the rate of Verizon. So as a long-term investment, I think your total return profile is probably a lot better.
I actually like T-Mobile better here. Better customer satisfaction, more willing to innovate and take reasonable risks there. I think you get slightly better returns there over time. It is still a telecom, though.
Thank you both Toby and to Jason. They've given Verizon a mediocre overall score of 6.3 out of 10, roughly matching its dividend yield. Look out for a new scoreboard every market day at 7 p.m. Eastern. Next up is JP Morgan Chase. Till then, Fool on. Because I calculate all these in my head, so...
Well, that's the way you should do it.
Absolutely.
All right, hold on.